pickup truck, well, even the average pickup truck now is going to be crossing over that $50,000 barrier.
The truck market just crossed a line, and the brands you trust most are about to take the hardest hit. The shift started quietly, inventory piling up, discounts getting deeper, dealers whispering about numbers they're not supposed to mention. But here's the part nobody is saying out loud. The 2026 crash won't hit the automakers first. It hits truck owners, their trade-in value, and anyone planning to buy in the next few months. So which brands are already losing ground? How deep will the resale damage cut? And why isn't the industry warning you before it's too late? Ford. Across America's truck lots, one brand's silence speaks louder than any statistic, and its familiar blue oval is suddenly carrying a weight it did not expect. The shift happening beneath its feet is not a mild market wobble. It is a pressure wave, building from years of aggressive pricing, expanding production targets, and a national economy finally pushing back. As the 2026 truck market contracts, Ford's sheer scale becomes its greatest vulnerability because no other manufacturer is carrying such a massive volume of full-size inventory into a tightening demand cycle. For decades, the Ford identity has been woven into American work culture, a symbol of dependability, grit, and engineering that supposedly never falters. That emotional anchor is exactly what makes the current downturn feel heavier. Many longtime Ford drivers believed the brand was functionally immune to market corrections. Yet across dealership lots this year, the reality is impossible to miss. Rows of unsold units trucks that once moved as quickly as they arrived are now sitting through 120, 140, even 180 days on the lot. A pattern that has not been seen at this scale since the economic crash of 2008. Behind those slow-moving inventories is a deeper structural mismatch. Over the past several years, Ford pushed hard into premium tiers and high-feature variants, assuming consumer demand would rise indefinitely. But as interest rates climbed and household budgets tightened, those elevated price tags rapidly became friction points. What once felt like aspirational upgrades now feel like barriers. The shift is so pronounced that some regions are reporting incentive spikes of nearly 40% above last year's baseline, a signal that retail confidence is slipping faster than executives anticipated. Complicating matters further is Ford's pivot toward electrification, a strategy that has required massive capital deployment while placing uneven strain on its traditional truck portfolio. Early electric ventures demanded substantial attention, diverting energy from refining combustion-based offerings that still make up the overwhelming share of Ford's sales. The result is fragmentation, an ambitious future plan colliding with immediate market instability. In a contracting environment, that dual-track approach becomes harder to sustain. Without sacrificing margin or momentum, this creates an unexpected moment of leverage. Trucks that once commanded unwavering loyalty now sit ripe for negotiation, with pricing flexibility that would have been unthinkable just 3 years ago. But for owners, the warning is clear. Resale values may not hold the familiar Ford strength as the market continues to correct. And if Ford's footing is shaking this much, the brand waiting at rank number 8 reveals just how unstable the lower tier truly is. Nissan. Behind the rows of unsold trucks gathering dust, one name reveals how quickly momentum can evaporate when a market turns cold. Unlike the domestic giants navigating a controlled slowdown, Nissan faces a deeper structural challenge, a shrinking footprint in the American truck space that exposes every weakness the moment the economy tightens. The 2026 downturn is not creating Nissan's vulnerabilities, it is amplifying them, turning long-standing issues into urgent risks. For many years, Nissan positioned itself as the value-driven alternative, offering trucks that promised fundamental capability at approachable pricing. That proposition resonated during stable economic cycles, but the landscape has shifted. As interest rates climb and household budgets constrict, buyers have become far more conservative, gravitating toward brands with stronger service networks, broader parts pipelines, and proven resale performance. Nissan, carrying a smaller dealer presence and slimmer national infrastructure, has struggled to reassure shoppers that long-term ownership remains a safe bet. The data emerging from dealership lots paints a stark picture. Trucks that once turned over within 60 or 70 days are now sitting for 110, 130, and in some regions, more than 150 days before sale. That slowdown forces discounting, and discounting erodes consumer confidence, a self-reinforcing cycle that Nissan has been battling for several consecutive quarters. Analysts tracking the segment note that Nissan's incentive growth over the past 12 months has outpaced outpaced several larger competitors, a sign that demand is not simply softening, but actively retreating. Compounding these pressures is Nissan's reduced investment trajectory in the United States truck market. Corporate strategy has increasingly prioritized international regions where volume potential is stronger, leaving American operations with fewer new platforms, fewer engineering updates, and fewer marketing pushes. In a market where constant evolution is mandatory, stagnation becomes visible quickly. And in 2026, visibility translates directly into vulnerability. This environment creates an unusual moment of opportunity. Negotiation leverage will be significant, with dealerships eager to move inventory that is aging on the lot. Yet for owners, the caution flag is unmistakable. Resale values may drop faster here than among higher volume competitors, and replacement support may feel increasingly stretched as Nissan reallocates resources. And while Nissan's struggle is shaped by shrinking influence, the brand waiting at rank number 7 faces an entirely different threat, one built from expectations that its premium image could once withstand anything. If this breakdown is helping you understand how the 2026 truck crash is unfolding, make sure you like this video and hit subscribe so you stay ahead of the brand's weakening fastest. The next updates will reveal shifts most buyers never see coming, GMC. Step into any premium showroom right now and you can feel it, an unmistakable tension rising around a brand that once seemed untouchable. For decades, the brand built its identity on elevated craftsmanship, upscale presence, and trims that delivered a sense of authority on the road. But in 2026, those very qualities become liabilities rather than advantages, because premium pricing is the first casualty when consumer confidence tightens. What makes GMC's position so striking is the speed at which its strength has shifted. Industry analysts have begun observing a trend that would have been almost unimaginable 5 years ago. Upscale buyers pulling back. Trucks that once lingered for barely 60 days on the lot are now extending well past 110, 130, and in some regions even 160 days before finding a buyer. That slowdown is not a small fluctuation. It is a tectonic signal that the upper tier of the market is losing grip faster than expected. The deeper cause lies in the brand's structural dependency on high-margin trims. Over the last several model cycles, GMC expanded its premium offerings, banking on continued demand for trucks that combined capability with luxury-level comfort. That strategy paid off in strong economic years, but in a downturn, it places undue pressure on pricing. As household budgets tighten, buyers pivot away from top-tier trucks in favor of more modest configurations, leaving GMC exposed across its core identity. Dealership data underscores the growing concern. Incentive growth on premium GMC units has surged at a rate outpacing several mainstream competitors, a clear indicator that inventory is accumulating faster than the brand can clear it. When incentives rise this sharply, perception begins to shift. A premium nameplate discounted too heavily sends a message that demand is weakening, and in the world of upscale trucks, perception is power. Yet within this instability lies a narrow window of opportunity for buyers. Negotiating leverage on GMC trucks entering 2026 may reach levels not seen since the aftermath of the 2008 correction. But for owners, the warning is unavoidable. Resale values on premium trims risk softening as the market continues to cool. And while GMC's challenge centers on the fragility of luxury appeal, the brand waiting at rank number 6 faces a completely different battle, one rooted in an identity that never fully aligned with America's core truck expectations: Honda. What happens when legendary reliability runs into a segment that demands identity over engineering alone? The answer is unfolding right now. For decades, Honda earned its status through engineering discipline, longevity, and a near unmatched track record for dependability. But in 2026, as the truck market contracts and buyer priorities shift sharply toward capability and long-term utility, Honda's position becomes uniquely exposed. The core issue does not stem from build quality or reliability areas, where Honda continues to perform at elite levels, but from perception. In the American truck culture, image carries weight, and Honda has never fully convinced traditional buyers that it belongs in the same league as the long-standing domestic leaders. This disconnect grows wider as economic pressure rises. Shoppers looking to tighten budgets gravitate toward brands with deep work truck heritage, expansive dealer networks, and confidence built over generations. Honda, holding a smaller slice of the segment, must fight harder for every buyer. Data from dealership networks across several regions tells a revealing story. Trucks that once turned within 60 or 70 days are now extending well past 110 and 120 days, reflecting a softening demand curve. While Honda's engineering quality remains respected, its narrow truck portfolio and limited heavy-duty presence create a visibility gap in a market where versatility is often the deciding factor. Compounding the pressure is a broader shift in consumer expectations. The 2026 downturn is pushing buyers back toward traditional fundamentals: toe strength, load capacity, and raw durability. Brands with a long history in these attributes experience a buffer. Honda, meanwhile, faces skepticism from shoppers who acknowledge its reliability but question its long-term fit in harsher, work-oriented environments. This perception challenge becomes more pronounced as households become more cost-conscious. Yet within this tightening market lies a surprising upside. For the first time in many years, Honda dealerships are showing increased negotiation flexibility. Incentive activity is climbing, a rare break in Honda's historically firm pricing strategy. For shoppers willing to look beyond image and into actual performance metrics, 2026 may deliver one of the most advantageous buying windows the brand has offered in over a decade. Still, Honda's struggle is shaped by identity, not engineering, and the brand waiting at rank number 5 faces an entirely different threat: the risk that its premium momentum may finally be running out of road. Ram. The glow of luxury-grade comfort dims fast when a tightening economy presses against a brand built on refinement. In the stronger economic years leading up to 2026, Ram thrived by elevating the driving experience, blurring the lines between work capability and luxury class interiors. But in a tightening market where budgets shrink and practicality becomes the deciding force, that premium-first strategy becomes a vulnerability. What distinguishes Ram's situation is the brand's deep reliance on higher-margin trims. Over the past several cycles, Ram invested heavily in upscale configurations, banking on consumers willing to stretch their payments for craftsmanship and ride quality unmatched by most competitors. That approach delivered impressive loyalty in prosperous periods, but becomes increasingly fragile as interest rates stay elevated and household spending tightens. Truck buyers who once embraced top-tier trims are now reconsidering, turning their focus toward essential capability rather than refinement. Dealer metrics from across the country reflect this shift with striking clarity. Inventory on premium Ram trucks, which once moved within 60 or 70 days, is now lingering past 110, 130, and even 150 days in some regions. This slowdown forces dealerships into deeper incentive strategies. Reports indicate discount growth accelerating at rates not seen since the aftermath of the financial downturn of 2008. That level of incentive pressure reshapes buyer perception. When a luxury-aligned truck needs heavy markdowns, confidence begins to erode. Compounding the challenge is the ongoing corporate restructuring within the Stellantis portfolio. Resources are being redistributed across more than a dozen global brands, making the competitive fight for investment sharper each year. Ram, once the star performer in the American market, now shares development attention with international nameplates, prioritizing electrification and global volume expansion. As a result, Ram's product cadence risks falling slightly out of rhythm at the exact moment market volatility demands precision. Yet despite these headwinds, there is a silver lining for buyers. Negotiation power in 2026 will be stronger than at any point in recent memory. For those seeking a truck that balances comfort with capability, Ram's shifting market dynamics may open doors to deals unlikely to return once stability resumes. But while Ram's challenges stem from premium dependence, the brand positioned at rank number 4 faces a different kind of reckoning, one that disrupts even its legendary reputation for consistency: Toyota. Even the strongest armor can crack, and the brand long seen as invincible is now staring down a shift it has not faced in generations. Yet, in the tightening truck market of 2026, even Toyota finds itself facing a new and unfamiliar strain. The dynamics that once guaranteed its dominance, conservative engineering, meticulous quality control, and a fiercely loyal customer base are now encountering market forces strong enough to bend even this long-standing giant. The shift began quietly. As Toyota transitioned into modernized powertrains and turbocharged systems, a portion of the fan base hesitated. Buyers accustomed to naturally aspirated engines and decades of predictable dependability suddenly found themselves weighing concerns about long-term durability, repair complexity, and elevated ownership costs. While Toyota's engineering record remains among the strongest in the world, perception carries tremendous weight in a pressured economy, and perception began to drift. That drift is now visible in dealership data. Trucks that once moved within 60 or 70 days are now remaining on lots for 110 and sometimes 130 days, a trend almost unheard of for this brand. A deeper pressure point lies in the rising costs embedded in Toyota's latest redesigns. As materials, technology, and regulatory demands increased, so did pricing. In stronger economic conditions, customers justified the premium. But in 2026, with families tightening budgets and interest rates holding stubbornly high, those premiums create hesitation. That hesitation is visible in the incentive surge sweeping Toyota. Lots discount patterns rare for a brand that typically maintains firm pricing discipline. The presence of such incentives signals a shift that extends beyond temporary fluctuation. It is a recalibration of demand. Compounding this challenge is Toyota's traditionally slow product cycle. While historically an advantage for dependability, this slower pace becomes a disadvantage when the market demands rapid repositioning. Competitors rolling out aggressive updates and diversified truck configurations now capture attention from buyers who once defaulted to Toyota without question. The brand's consistency, while still a strength, risks appearing static during a period when economic volatility demands adaptability. For the first time in many years, negotiating a Toyota truck becomes genuinely possible, offering a rare opportunity to secure long-term reliability at a more approachable price. But for current owners, the signs of softened resale value serve as a quiet but important warning. And if Toyota's long-standing armor is showing fractures, the brand rising at rank number 3 reveals just how severe the correction can become when sheer volume meets a shifting market. If you rely on information like this to protect your money and avoid the wrong brands during the coming market shakeout, subscribe now. The next part of this countdown exposes changes that will impact thousands of truck owners before they realize what's happening. Chevrolet. When a giant moves, the whole market feels the tremor, and the rumble around this one is growing louder by the day. In a contracting 2026 market, volume is no longer an advantage. It is a liability. When demand tightens, the brands with the most inventory on the ground feel the first tremors, and Chevrolet's expansive footprint places it squarely in the center of the correction. What makes Chevrolet's position uniquely turbulent is the imbalance forming across its vast trim range. Over the past several years, the brand has expanded into numerous configurations to capture every slice of the market, from fleet utility to premium-focused consumer models. In stable economic periods, that strategy offered flexibility and reach. But in a downturn, too many configurations mean uneven demand, inventory buildup, and heightened pressure to discount. Trucks that once transitioned from delivery to driveway within 60 or 70 days are now sitting 110, 130, and even 150 days in multiple regions. The economic ripple effect is immediate. Dealerships are responding with incentives, rising at one of the fastest rates among domestic truck brands. Analysts tracking incentive activity have noted that Chevrolet's upward climb over the past 12 months exceeds several of its closest competitors. Incentive depth is not merely a pricing tool, it is a signal of stress. When discounts grow this quickly, they reshape market psychology, causing potential buyers to delay purchases in anticipation of even deeper cuts. That hesitation creates a feedback loop of softening demand. Compounding this challenge is Chevrolet's role within General Motors' broader electrification ambitions. Corporate resources are being allocated across a complex portfolio that includes electric truck development, crossover expansion, and global strategy realignment. While electric platforms draw significant investment, traditional truck offerings face increased pressure to maintain momentum despite thinning consumer enthusiasm. In a tightening market, that dual priority split introduces friction across product planning and brand positioning. The situation offers a rare advantage. Negotiation power on Chevrolet trucks entering 2026 may reach levels not seen since the early aftermath of the 2008 downturn. The combination of high inventory, swelling incentives, and shifting demand creates one of the most favorable buying conditions in recent memory. But Chevrolet's battle revolves around scale, where volume becomes a burden. The brand rising at rank number 2 faces a completely different challenge: the fragility of growing too fast without the foundation to support the weight. Hyundai. Rapid rise can be thrilling, but in a contracting market, speed without foundation becomes a fault line, and this brand is standing right on top of it. In the stable years leading up to 2026, Hyundai's expansion into the truck segment looked strategic and well-timed, but a contracting market is unforgiving, and the brand's limited heritage in American truck culture becomes a central vulnerability the moment consumer confidence tightens. The story begins with trust specifically, the kind that develops over generations. Truck buyers in the United States often rely on brands with deep histories, proven capability, and widely distributed service networks. Hyundai, despite making impressive progress, simply has not had enough time in the segment to create that foundation, as interest rates remain elevated and families reassess spending. Traditional truck shoppers are gravitating toward established names, leaving Hyundai exposed in a way mainstream sedan and sport utility buyers rarely notice. Dealership data illustrates this shift with startling clarity. Trucks that once cycled off lots within 70 or 80 days are now stretching past 110, 130, and in certain regions, 150 days. That slowdown forces dealerships to deploy increasingly aggressive incentives. Over the past 12 months, discount growth has accelerated at a pace that analysts describe as a confidence correction, signaling that demand is not only softening, but actively retreating. Another tension point lies in Hyundai's still fragmented support network for truck ownership. While the brand maintains strong urban coverage, many high-towing, high-usage regions remain better served by its competitors. Buyers who depend on roadside availability, deep parts pipelines, and specialized service departments place enormous weight on accessibility, and Hyundai's footprint still developing rather than mature cannot yet match those long-standing market giants. A unique advantage appears for buyers entering 2026. Hyundai's willingness to negotiate, combined with feature-rich design and contemporary styling, creates rare opportunities at price points far below typical market cycles. For cost-conscious shoppers, the coming months may deliver unusually competitive deals, especially as inventory pressures mount. For current owners, however, the concern is different. Brands without deep truck legacy often experience steeper depreciation during downturns, eroding trade-in strength faster than expected, and raising long-term ownership questions as market volatility reshapes confidence across every major segment throughout the evolving 2026 landscape and beyond, as conditions continue shifting rapidly forward. And if Hyundai's struggle reflects the fragility of rapid expansion, the brand at rank number 1 reveals what happens when niche identity collides with a once-in-a-generation market reversal. Jeep. Icons are supposed to endure, yet even legends can stumble when the ground beneath the market gives way faster than anyone imagined. Yet, in the tightening truck market of 2026, that storied image now confronts a financial and structural pressure intense enough to shake even a legacy this iconic. What once felt unbreakable is suddenly showing strain, and the cracks are widening faster than most observers expected. The core of Jeep's challenge lies in pricing. Over the past several years, average transaction costs crept steadily upward as the brand leaned into lifestyle-driven trims and higher-margin configurations. During strong economic conditions, buyers embraced the adventure-centric identity. But as interest rates remain elevated and monthly payments stretch beyond comfort zones, consumers are reconsidering whether that premium aligns with their current priorities. Dealer reports show trucks lingering on lots for 110, 130, and in some regions more than 150 days, numbers that would have been unthinkable during Jeep's earlier momentum. Compounding the slowdown is a shift in buyer psychology. When markets tighten, shoppers gravitate toward practicality, towing strength, and long-term utility. Jeep's unique niche part capability, part lifestyle, does not always fit neatly into that framework. As a result, some potential buyers hesitate, viewing the brand's signature personality as a luxury rather than a necessity. That hesitation translates directly into incentive spikes, with discount rates rising at some of the fastest speeds across the segment. Corporate strategy adds another layer of pressure. Stellantis oversees more than a dozen global brands, and resource allocation has become increasingly competitive. As electrification demands capital and international markets expand, Jeep must now fight harder to maintain development priority. When budgets stretch thin, niche-positioned brands feel the strain first. This dynamic becomes especially visible in a contracting truck market where every misalignment grows louder. faster. All of this creates a surprising and potentially game-changing advantage. Negotiation leverage on Jeep trucks in 2026 may reach levels unseen since the years following the 2008 downturn, offering opportunities for savings rarely associated with the brand's rugged image. However, the situation carries a sharp contrast for current owners because the warning is unmistakable. Resale values that once held fiercely strong are beginning to soften under the weight of shifting market realities, accelerated depreciation patterns, and growing consumer hesitation, signaling that Jeep's long-trusted value stability is entering an unfamiliar and volatile chapter right now. And if Jeep's struggle marks the sharpest edge of this collapse, the broader story is even larger. The entire truck landscape is recalibrating, reshaping what strength, value, and loyalty will mean in the years ahead. The truck market is shifting faster than anyone expected, and the next year will reveal changes most drivers won't see coming. If this breakdown opened your eyes, drop a comment and tell me which brand you think gets hit next. Make sure you like, subscribe, and turn on notifications so you never miss the updates that could save you thousands. The road ahead is changing. Stay ready.